fellow investors. Welcome back to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Sam Bates, and Sam is the founder and CEO of Bates Capital Group. Sam has been involved in over $140 million in multifamily transactions and assets, from acquisition to asset management, disposition, and everything in between. And he and his partners currently have 924 units in Texas and throughout the Southeast, and roughly another 120 units in the pipeline for new development. So Sam's got a lot going on, and we're excited to dig in today with him and learn a little bit more about what it is.
Well, Kent,
Sam,
go ahead. I'm sorry.
no, Sam, just thanks for being here.
Yeah, thank you for having me. I'm excited to talk to you and hopefully share some value with your listeners.
Yeah, but let's get into it. Let's start right at the top, Sam. You obviously have built up a nice multifamily portfolio now, but you didn't start there. So tell us where you started and kind of how you got to be where you're at today.
Yeah, definitely. It started a long time ago, and I was a finance major in undergrad, and I actually thought about going and getting my master's in real estate. But at that time, I had no idea of what syndication was. I didn't honestly really even know what a real estate investor was. I just thought it was kind of the next progression, and I was going to be a mortgage broker or officer at a bank or something like that. And through, I guess the senior year to before I enrolled in grad school, I had an internship with UBS out in Los Angeles, and I loved it. And then they offered me a job as an investment analyst. And since I'd graduated, I just decided to stay out there and not come back. And I was there for a couple of years and really enjoyed the experience, and learned significantly more about the market, the stock market and bond market, than I had ever learned or dreamed of in undergrad. But I knew I always wanted to get a master's, and my family's always been a big proponent on education. So I went back and got my master's. During that time, the market tanked, and I saw clients, family members lose 30 to 50% of their portfolio essentially overnight. And I knew I didn't want to be a part of that, or be able to raise money from investors and they lose it in a heartbeat. So I graduated with an MBA and a master's in personal financial planning, and I started consulting in Dallas, and I was at a few consulting firms, and going from an investment analyst where I was talking on the phone significantly, doing some research, but it was research I loved, to going and researching tax laws and oil and gas equipment for 12, 14 hours a day. Sometimes it just was not what I envisioned a career to be. So I kind of, by lucky intervention between a guy, I took my TV to get repaired, and we started talking, and he found out I had a finance background. He started telling me about real estate and this investment group in Dallas. So I went and looked at it. And I first was a limited partner in a couple deals. And then I did single family from 2010 to 13 or 14, and realized you couldn't scale. And I did great on the single family returns, probably even better than the multifamily, since I was buying them. I was buying 3-bed, 2-baths for under 100,000, completely rehabbed. But I just knew you couldn't scale. So in 14, I started looking to buy small multifamilies. And from 14 to about mid 15 or 16, we weren't getting anything. I had a couple brokers tell me they didn't trust me since I was young. They didn't trust that I could close. And after banging my head against the wall for a while, I reached out to a guy who had been in construction for about 20 years. And then another person that I worked with at a consulting firm, and we came together and built a 60-unit apartment complex and then 10,000 square feet of retail space, and it's kind of went from there.
Wow, that's a heck of a start. You just started right out building from the ground up, huh?
Yeah, since I partnered with a guy who had been in the business for 20 years. I had a lot of surety that he was going to be able to perform. Like, I still wouldn't take on a development project by myself. There's just so many nuances that I don't feel comfortable with from the construction aspect, or I don't have the teams in place to be able to do it. But I think partnerships are critical in real estate, and they've exponentially they've increased my growth rate exponentially. And if you can partner with the right people, the guys or girls that have the same beliefs, have same work ethic, kind of have your same values and vision, I think they're great. And the first one was a success, and we just decided to continue going down that path.
And how many units have you developed now?
I don't know that off the top of my head, but out of the 13 GP projects, we've done 7 developments. But one was a lot development that we took raw land and turned it into a residential subdivision. One was the development that we just did the horizontal construction on, and we're selling the land to a REIT for them to build. So probably 400 to 500 of the units are from the development perspective.
Oh, gotcha. That's awesome. So you're kind of 50-50 in your portfolio of what you've developed versus what you've acquired.
Yeah, it's great because I mean, acquisitions, you can buy them in really 60 to 90 days, and you can start getting that cash flow for investors almost immediately or within 6 months to close or whatnot. And development's a lot different. I mean, depending on where you buy the land at and how it's zoned will depend on how long you have to go through the zoning process. And I mean, one deal, it took us almost 3 years to get through planning and zoning. So we were doing that without any investors. And then once we got it approved by the city, we brought in investors, and then a construction period can take 15 months to lately it's taken a lot longer just because the supply chain issues, the shortages and materials and labor. Like we have one project we'll be finishing that's been almost a 3-year build process just because COVID and everything that slowed the build process down.
Gotcha. Well, that's a really interesting perspective, having both sides like that. And I mean, how do you see? You talked a little bit about, obviously cash flow, no cash flow, but how do the return profiles differ on the deals you're doing from a acquisition side to a development side?
The
Just
returns,
generally.
the returns differ greatly. I mean, especially if you get acquisition from a broker, which realistically, if you get 100+ unit acquisition, it's going to come from a broker, and you have a lot of competition. So the acquisitions we projected 15 to maybe 18% IRR, and luckily on the ones we've exited or about to exit, we've done significantly better than that. Like one we have listed where we'll probably return the investors a 32 to 35% IRR. But I don't think that's repeatable, especially now since cap rates have compressed and it's just that much more competition. But on the development side, we have a deal listed where we'll 3x the investor money in about 27 months. The retail deal that we developed, we provided a 41% IRR in 16 months. The land development, the equity multiple was about 2.5 in roughly 3 years. So the returns are significantly better, but there's just more uncertainties, and some people just don't want to add that risk into their portfolio. Some people love it and they're more entrepreneurial minded, or they have a larger nest egg where they can take that risk. But some of our investors, they're essentially coupon clippers, and they want that consistent cash flow because they live on it to either pay their bills or retirement. And so the risk profiles of the different investors is critical to actually figure out what their risk profile is and let them know the differences, because it does take a different investor that wants to invest in a development than it might on an acquisition.
Yeah, I think you made a really good point there because if the goals aren't aligned from the beginning because the investors maybe don't really understand right all the aspects of it, then you're not setting yourself up or them for success, right? And that's going to be a troubled relationship through the process when they're in 6 months into a development deal and they're calling you asking when they're going to get their distribution, right?
And luckily, we've done a really good job of explaining the timing and the risk and different things. But in developments, you just don't know. Like one of the developments, the city told us we were going to have the city pay for a road that was literally 6 feet, and they backed out of that. So we had to bring an additional 500,000 to the development, and it's just there's risk or uncertainties that you can't plan for. And like, luckily, most of our investors have been happy. There's been one in particular referral we had that it would have been a lot better if she would have invested in an acquisition than development. I don't
Mhm.
think she understood the timeline. So we've had to teach and coach her a lot more than we have with the other investors just because she was new to real estate and didn't exactly know what all could transpire in a development.
Sure. Sure. Yeah, I can imagine that comes up pretty often. Well, so as you're looking to move forward, where are you focusing your time on now? Is it development? Is it acquisition? Is it a blend of both? And kind of how does that work?
Right now, it's more acquisitions. Once lumber prices shot up, labor shortages, and also other materials, like on one development, we waited 5 months for windows.
Mhm.
So it puts a kink in your plans and your pro formas. And right now, at least, I'm focused more on acquisitions. I know the returns can be better on development, but I just kind of want to see where the supply chain shakes out. Um, and the land over the last couple of years in Dallas Fort Worth, it's skyrocketed. So it's harder to make deals work or pencil. And with material increases and jumps, I mean, we were building developments for, and granted, these are secondary cities at DFW, so we're getting the land really cheap, but we're building them for $80 a square foot on some of them. Some of them we could basically build a unit, and these are large units for 105,000. The last deal we underwrote that we're looking, and we still might develop it, we're at 135, 140 in cost per unit. So
Mhm.
the cost is just completely changed, and that's going to definitely hurt the returns. So
And are those kind of B class suburban, like garden style? Is that what you're building?
they're they're garden style. Some we've done really well in on they're essentially fourplexes, but they're nice townhome looking
Hmm.
fourplexes, 2 story, 3 bed, 2 bath. But the the apartments are definitely garden style. I would say they're A class for their area, but if you put them in uptown Dallas or a downtown of a major metro, they'd probably be a B plus, A minus. But
Yeah.
we import a lot of the materials from Asia, so we have nice vinyl plank flooring, we have quartz countertops, custom cabinets. It's just we don't have all the amenities that somebody would expect in an urban location now.
Gotcha. Gotcha. So yeah, so prices have gone up anywhere from sounds like 30 to 40%.
Yeah, exactly. And some of the materials maybe even more than that. Um, and one of the issues we're finding, and not even just developments, but from our acquisitions, is labor. With all the stimulus and the government funding, it's hard to keep good qualified people. Like in one of our properties, we've went through probably 5 or 6 maintenance guys since COVID's happened because they're
Yeah.
collecting more money
Yep.
than they're making, or they're collecting just a little bit under what they're making. So it makes sense to them to work 40 hours a week.
Right.
Um,
Yeah. I mean, yeah, I'm glad you say maintenance because that was the first thing that popped into my head too, because I know that just, in a lot of the cities that we're investing in, just in general in a city, I mean, maintenance people are a premium. And so, and you come down to your individual apartment, it's difficult to find folks. And I know that The company I worked for, we've had several maintenance positions open for quite a while. It seems like it's a tough job to fill right now. It makes me wonder if that model has to change. The model of having just the maintenance guy dedicated to the apartment, that's on call and doing all the work. It seems like that's it's not sustainable anymore. Like you said, folks are making more money going other places, or
Yeah,
just staying home based on the government checks. But even going in what I've seen more is people going and getting a job with HVAC or plumbing or specializing, and you can make quite a bit more.
Yeah, and for our lead maintenance at all of our properties, we require them to be HVAC certified. And to your
Hmm.
point, like if they are HVAC certified, they can work for HVAC contractor and make significantly more money. So
Yeah.
I think there might be a shift in that. Obviously, I don't want that to happen because I think it's just going to drive up uh, maintenance or repair costs. But it could definitely be something that happens in the next decade. I know
Wow.
one of our properties, we've basically just had to go to a staffing agency and get labor or maintenance guys from there because the people we were hiring, they were leaving after a week or two, and there wasn't enough of a market pool to bring in those people. But that property was in a smaller market of 90,000 or so. So in your larger markets, I think you're going to have a lot bigger base and hopefully a bigger base to choose from.
Hmm. And so that's a good segue into markets, because I wanted to ask you, what are the markets that you guys are actively looking in right now, and maybe you can give us some examples of actual markets, but then like just criteria wise, what is it that helps you define a market?
My thought process over the last 5 or 6 years has honestly changed. We've had a lot of success in secondary and tertiary markets, and I am still considering stuff, especially developing there, but I don't know if I'd buy there again. Just because cap rates have compressed so much that I would much rather buy in a primary market at a 4 cap or 3.5 cap versus buying a secondary market at 4.5 or 5 cap. Um, and maybe that cap rate's a little bit low, but I mean, I'm seeing deals in Austin trade under a 3. So
Yeah.
I think it's going to continue. And any market we look in, I make sure there's population growth, there's job growth, and rent growth. Those are kind of three primary drivers. And then I'll look at median household income, and it depends on if it's an acquisition or versus development, and it depends on the class. Like we have, I mean, our oldest property right now is 1972. Our newest acquisition is a 2017. And then from a development perspective, we have 2020 and 2021. So depending on the asset class will depend on what median income I require, because the rents are going to vary. And
Right.
then um, I think luckily we're blessed to be in Texas, or I'm blessed to be in Texas, and everybody's moving here. So uh, I've looked at DFW, Houston, Austin, really since 14, and just have never been able to get a deal. I mean, hindsight's always 2020. So at each time I was offering less than what it took to buy it, but and maybe that'll continue. And that's honestly why we went to the Southeast, and um, we have a deal right south of Memphis, Tennessee. It's actually in Mississippi, but it's been phenomenal. We have a deal in a suburb of Atlanta that we closed in January, and I was looking at our unit mix and rents last Friday, and we have raised rents on average $269. And then the last acquisition was in a suburb of Orlando. So I'm still looking at cities that have a lot of growth and the economic drivers behind them. But I've luckily found a couple good property managers that are either regional or nationwide. And if they're in a market and I believe in the market, I have faith in them to go in and execute a business plan that we've created.
No, it's great to find those partnerships. I was going to ask, and maybe that's the answer of, going into these different markets, you're obviously in Texas. I know you have a few partners, but you can't be boots on the ground everywhere. How do you how do you enter a new market, and how do you manage from afar?
Early on, it was honestly trial and error. The first property we built was 5 hours away from us, and it was about 60 minutes northwest of San Antonio in a market that is median household income is extremely high. It's a retirement community, and there's probably average median house values 700, 800,000. So you have a lot of affluent people, then you have a lot of um, very low end working class, like blue collar type apartments, but there was absolutely zero apartments built within the last 10 years. And we did some market studies and we realized there was a great demand for it. So we built it, and we went through two property managers before we found a third one that made sense to us. And one of the property managers was actually an investor of ours, and he was managing from Dallas, and he just didn't have the right people in place. So I was going down there. I'm more of the boots on the ground operations after we raised the funds. And I was going down there a significant amount of time, and I was like, this cannot continue to happen. So we vet the property managers a lot more. And now I've worked with probably 8 property managers. They all have strengths, they all have weaknesses. But I've learned if I can actually interview the on-site staff, that's going to help tremendously, because we've had third-party managers that we've used at one location and they've done phenomenal, and at another location they didn't, and it boiled basically down to the on-site staff and the regional. And
Mhm.
even though they managed $1 billion of assets and claimed that their systems were streamlined, I quickly realized that was not the
Yeah, it's never as pretty when you see how the sausage is made, right?
exactly.
But I think it's a great point you just brought up to interview the on-site staff, because you're right. It's so dependent on the individuals on site. I mean, you can have all the good systems in the world, but it comes down to the people at the end of the day.
It is. And like one of the biggest mistakes I've made is I trusted in the third party management company and I didn't go with my gut, because the first time I met the on-site person, I knew she wasn't a fit for the demographic. And I was like, well, I trust the manager to make the right decision on their hiring. And at that point, we had never interviewed anybody, but it was it was quickly apparent that she wasn't the right fit. And I waited a few months, probably too long, to fire. And I asked the regional to fire and she wouldn't. So we had to get rid of the third party company in general, just and replace them with somebody else that would listen to what we needed to execute the business plan.
Yeah, absolutely. Well, that's critical. So you talked about the shifting cap rates a little bit, and you guys have seen that happen more than most in Texas, right? It's kind of happening everywhere, but I mean, Texas has been kind of one of the epicenters of it. So I'm curious, how has that changed your strategy of just going from a couple years ago to like a 5 cap to now, like you said, three caps? I mean, how do you alter strategy to account for that?
That's a great question, and it's really hard. I know if you want a deal that's marketed right now, you have to be somewhat aggressive. Like everybody says they underwrite conservatively, and you definitely do need to underwrite conservatively. But like previously, we were expanding our exit cap 10 basis points per year, or maybe even 20. So sometimes we were exiting at a 7 cap when we were buying it at 6 cap.
Yeah.
And we've definitely changed that in underwriting, where um, well, maybe it'll be a 10 basis point spread, but even then, realistically, we won't get the deal if that's the case. And it kind of depends on the market. Um, and now I'm focused more, since I have a track record and brokers can trust that I can close, I'm focused on more of the primary markets.
Hmm.
So I think in the areas we're looking in, cap rates are going to stay the same or potentially even compress more. And I've talked to a lot of people and a lot of veterans that have been in the industry since the 80s and 90s, and that's their fill as well. And Over the last 5 to 10 years, I mean, with social media, with technology, and a lot of different factors, but it's real estate's now investing in syndications is mainstream. Where when I invested in my first deal as a limited partner, I don't think many people had even heard of what a syndication was. Like I invested with a guy who'd been in the business for 15 years and it was quote unquote his first like PPM and that syndication process that he had ever done.
Hmm. What year was that?
It was 2009.
Oh
So
yeah, that was early on.
yeah, so it's just become so commonplace and interest rates are so low across the world and you have capital coming in from all different asset classes, industries, other nations that even if interest rates increase, I've read where interest rates aren't always correlated with cap rates. And I think cap rates could just stay compressed where they are, maybe even decrease. I'm not putting that in my underwriting, but I think it's a good bet that they're going to stay that way. So maybe we can keep the underwriting cap or the reversion cap rate the same as the entrance cap rate on a stabilized deal and maybe be a little less aggressive in some other areas.
Hmm. Yeah, it's an interesting conflict, right? Because, like you said, everybody wants to say they underwrite conservatively.
Yeah.
The general rule of thumb forever has been kind of 10 basis points increase a year, right, for every year you hold it, right? But that's difficult for a couple of reasons, right? One is well, that's not the reality of what's played out in the last, I don't know, close to probably 10 years. And then also, if everybody's doing it, then how do you win the deal if you're doing what everybody else is doing, right?
Yeah.
Like you said, you have to be willing to be a little more aggressive in certain areas. It seems, but on those on market competitive deals, right?
And like we have a deal under contract now in East Dallas that is complete off market, direct to seller, and we're a lot more conservative in our projections. And I think it's going to be a, a grand slam, maybe one of the best deals we've ever gotten, but it was truly off market. And if it would have been grabbed up by a brokerage shop, we probably wouldn't have got it.
Yeah.
Or if we did, it would be at a significantly higher price.
Yeah, I mean it is interesting, and we just had a situation where we had a deal under an LOI. There was direct to seller strategy. Deal was under LOI, and a broker swooped in and told the guy that he could get him, you know, about do quick math, about 18% more than what we were offering, and the guy dropped to and we were stretching it at that number. Honestly, I mean, we were stretching our underwriting to get to the guy's number to try to take it down and avoid him going to market. But and it was, I mean, it's just easier to know the numbers. It was like we were at 5.2, and then a broker came in and told him he could get him 6 for it. And so the guy backed out of our LOI, and now he's taking it to market. And I don't know. Somebody might pay 6 million for it. I didn't think it was worth more than 5.2, but it's just to your point of kind of the difference between an off-market deal and an on-market deal. I'm sure somebody will pay 6. Somebody might pay 6.2 for it.
Yeah, yeah.
We'll have to see.
Before we jumped on the call, we were kind of talking, and I was in Charlotte the last couple of days looking at deals, and there's a deal that it's in a core plus area, great location, Charlotte, and they initially whispered 290 a door. Now they're saying 310 a door, which it's a 180. Maybe I shouldn't say the exact unit, but it's a larger.
Yeah.
So it significantly increased the purchase price, and I guarantee somebody's going to pay that.
Yep. Yeah. Yeah. It is interesting. So when you're so in that market, or in a market where you're operating with three caps, let's say, how about from a value add standpoint, from like a renovation scope standpoint, has that changed? Knowing that for every dollar you can tweak the NOI, you can even increase the valuation that much more. Are you doing more more because of that? Are you doing less because it's more expensive? Like how has that changed the strategy?
Well, luckily we haven't bought anything in a three cap market. um,
Okay.
like the lowest uh, purchase we've done is a four cap, but some of the markets we're looking at have got to the three cap.
Yeah.
But to
Still
answer
in a lower cap rate environment,
the
how does that adjust?
question, I focus a lot on mismanaged operations and how the previous owner, property manager, whoever's managing the asset, what they've done. And then obviously we want to go in and be able to renovate it to another level that's a, a comp in the market. So all the assets we've bought, we've always went in and done renovations. It kind of depends on to what level. Like this last acquisition was built in 17, and for some reason the developer built it like a B class property, even though it's in an A class 90 plus thousand median household income area. So we're going in and putting in granite or sorry, quartz counters, stainless steel appliances, just anything a young professional would expect when they're paying 1,500 a month for one bedroom. But I think anybody can do that, but where we find value is just from mismanaged operations. And partly you could say not raising rents is mismanagement. But the last really three deals I've bought, the on-site managers were absolutely horrible. And like in Memphis, granted, we've owned it now for a little over 2 years, but we've raised rents with rubs $350. In Atlanta, we've been able to raise them $270 in 6 months essentially. And we're in the Florida deal, we've already increased lease renewals by $200 on average, or 220 or so.
Wow.
So there is still opportunities even in the low cap rate environment. It's just harder to find them. And I mean, the deal in Atlanta was off market. The deal in Orlando we preempted before the bidding process could get bought up. And the Mississippi deal, we weren't the highest bidder, and the person who got the LOI accepted, they couldn't figure out a PSA, so the broker came back to us and asked us, and we submitted an offer. We got accepted, but it was a little bit lower than what we initially submitted. So I feel like we've been very successful in getting deals without having a ton of competition, but that's why in 3 years I've only bought three deals. So
Yeah.
you have to be selective.
Yeah, absolutely. And just going back to what you were saying about mismanagement, I mean, be more specific, what are you seeing on these? Like when you look at a deal from the outside, what's something that says to you, oh man, I know there's opportunity here?
If you're underwriting, I know some groups that have analysts, and they can do this, but if you're starting off and just underwriting all the deals you get, and maybe now that I'm in a lot of markets, I can be underwriting or have my analysts underwrite 100 deals a month. And if you aren't digging deep into it, you won't see it. But like when you go on property tours, you can ask a lot of questions. One of the biggest things I found value from is revenue management systems. And they can be great if you have somebody that knows how to input the data, but it's garbage in, garbage out.
Hmm.
And like one of the properties we bought used the previous owner used a revenue management system, and on the rent roll, they had the two bedrooms with a $5 difference in some of the three-bedroom units. And it just makes no sense why you'd charge $5 more for a three-bedroom versus a two-bedroom.
Hmm.
One of the properties we bought, the Mississippi property, we bought from a hotel operator who had a small multifamily portfolio, and they just didn't know how to operate it. Like they were paying literally all the utilities for the residents. Like they even were paying cable and internet for the residents with no bill back, nothing. So those are two big areas. I think going in and I, I don't know how many properties I've toured, but you can definitely tell if the owner slash manager doesn't take care of the property, your tenants don't take care of it. I think
Hmm.
there's just simple things you can make a property look nice and clean. And if you have pride ownership, the tenants are more than likely going to have pride ownership. And this East Dallas property we have under contract, I mean, the owner is he's owned it for 30 years, but he's a complete slumlord. He bought it, I'm sure, for I don't know, 5, 10,000 a unit. He does all the repairs, he does everything. And he's worked really hard, but you can tell he's just doing whatever he can to get by. And you can tell that from the tenants that are in place. Like we're gonna have to go in and remove probably 100% of the tenants. I mean, there's stripper poles in some of the units. There's, I mean, some are meth units. You can walk in and just completely tell that a meth addict's lived there for years. So, just being on site, asking pertinent questions, I think is a great way to tell how operations are running.
Hmm. Yeah. So a couple of things you said. One is just the revenue management system, or it sounds like just pricing disparities among the units, right? You see there's not a delta between twos and threes. You see, I mean, you even see crazy stuff sometimes like twos that were renting more than threes or vice versa. So just kind of looking at the rent prices and saying, do these make sense? And you said actually getting like into the rent roll and seeing what's in the rent roll, right? Because I think that can be very telling on just the different prices you see and kind of how they operate. Then uh, rubs or just utility bill backs, right? So that's a huge opportunity if folks aren't billing back utilities. I mean, we have a couple properties under contract right now where it's opportunities on both of them, or just get the utilities off of the property's books and get them back to the residents, and that's a huge expense savings, right?
Yeah,
And
it is.
yeah, and lastly, you said just pride of ownership, right? Of just being able to just evaluate, is there that pride of ownership, is the property clean, are people taking care of it, and likely there could be easy upside there and just better maintaining the property, right? And getting the right, and in doing that you'll get the right tenant in there as well.
Yeah, exactly. And all markets are not created equally. Luckily, I'm in Texas, and a lot of our properties are in Texas, and I feel like owners in Texas are cutthroat, and you can see just from underwriting deals, you can see a lot of things from an operational standpoint that other owners do, and you can learn from it. And now I've been in real estate for 11 or 12 years, so I've read a lot, listened to a lot of podcasts, and my knowledge base has grown significantly since even 5 years ago. I mean, I look at stuff, my underwriting from 5 years ago, and I laugh at it. But if investors listen to podcasts or do reading or talking to brokers or industry professionals, like you can figure out a lot of ways to enhance value in your market that might not be happening now. And like that's been one of the only drawbacks or pushbacks going into other markets is the management companies in those markets aren't used to certain things or fees that we can charge in Texas, and they push back
Hmm.
on it a lot. Like one property manager, they manage two of our assets, and we could easily implement cable and internet package for our residents. They benefit from it, we benefit from it, and we've been going back and forth for literally 4 months on it. And the property manager keeps pushing back on us because they just don't understand the concept.
Interesting. That is interesting. Yeah, I mean, that's a no-brainer for me.
Exactly.
Yeah.
And I was talking to a guy that's in Iowa, and just some of the things that they do and what he does is like it just blows my mind. But he says the tenants, they don't expect anything more, so they'll pay maximum value for a unit that is basically in the 80s or 70s in Texas. But he's like they're happy with that in Iowa. So um, it's
It's
uh,
interesting to learn though. Learn how people are doing it in different places, and it's different in every city, right?
I know, and I told him you should do this and that and that. And he's like, I've tried it on other properties, and you just don't get the rent bump. that
Yeah.
you would in specific markets.
Yeah. That's an important lesson too, is, don't over improve it and do things just to do them. Make sure that there's going to be a return and you're going to be able to increase the rents, right?
Exactly. I mean,
Yeah.
ROI is by far the most important factor in decisions that should be made. So if you can't get a return on investment, you probably shouldn't do that.
Yeah, absolutely. Well, Sam, it's been so much fun having you here today and getting into some of the nitty gritty with you. And I think it's been really valuable to the folks listening and to up their game on both how to look at deals and or how to evaluate deals that they may be looking to invest in. And now, before I let you go, I want to take you through our keys to success round. There's 4 questions I want to ask you. And the first one is, so put your investor hat on, your passive investor hat. If you could only ask your deal sponsor one question, what would that question be?
That's a very good question. And it's hard to ask just one question, but I think outside of anything, I would want to know why is a lead sponsor or she's a lead sponsor. And I think from that question, it can shed a lot of light into who they are as a person. And then obviously that will create more questions. But if somebody's doing it just to make money, or if somebody's doing it just to grow their unit count to 40,000 or 5,000, 10,000, whatever, I probably don't want to be investing with that person.
What are you looking for in that answer?
Um, I think there's a lot of things, and it helps possibly know why they're investing in real estate, what their worldview is. I mean, from that one specific question, it might be hard to get down into the nitty gritty, but um, how they determine success, what they think a successful investment is. There's a lot of things that could stem from that one question. And I mean, another great question I think is share how you've experienced, or share your failures and how you've overcome that. I mean, because multifamily and real estate in general isn't going to go to 100% plan.
Mhm.
So like life, and depending on how you can mitigate or how you respond to failures, I think is paramount. And I know from some of my largest failures is the most growth that's occurred in my life. And I hope other people that have went through failures can say the same thing.
Yeah, absolutely. That's a great perspective. So next question is, what are you most proud of in your career?
I think I'm most proud of just being able to provide, well, I have a lot of goals in real estate, and that's why I'm investing in syndicating. And I look at each investment or development as helping essentially 3 shareholders, and that's the tenants, the city that we're investing in, and then the investors. And one of my goals is to make as many millionaires through real estate investing as possible. And every property we go into, we make better for the tenant. Granted, we do increase rents, but we make their lives better, their place of living. We improve it, make it cleaner, create community within the apartment. And then the city, like this one that we have in East Dallas, this is a complete eyesore. And we're going to completely revolutionize it. And it's going to be something that I hope city officials are happy with. And it's going to increase tax base. It's going to increase a lot of revenue for even the city that I'm just thankful that I've been able to do it in multiple locations, pour into people in multiple ways, and just continue to grow and hopefully impact more people throughout this process.
Yeah, that's awesome. You're making a big change through what you're doing. And I agree with you. I think there is a positive social impact to what we do. And you're improving, making clean, you know, relatively affordable housing. And
Right.
a lot of people don't have that option. Like you said, the people that are living in that guy's building out in East Dallas right now, in those poor conditions, and you come and improve it. And yeah, that's awesome. So, what is a book that everybody should read?
I've I've read probably 150 books in the last 2 to 3 years. So there's a lot I could recommend. And maybe it's just because it's top of mind since I'm reading it right now. But it's a book called Who, Not Why. And it's simple concepts, but it's been kind of earth shattering to me. And throughout my career, I've been very hands on, and I've worked a lot of hours over the last 12 or 13 years, and I've realized I need to start outsourcing a lot of my responsibilities and activities. And I've already hired a couple people to help do that. But this book is just great on how to basically remove yourself from the business, or remove yourself from whatever you're doing to help it run as a true business, and not be the sole person responsible for every aspect of that business.
Yeah, that's a great lesson. I think it's the only way to really grow.
Exactly. And um, I it helps you realize you don't need to be focusing in the business, but focusing on the business. And you think you can do it better than somebody else, and that's not the case. And
Right.
you're helping them, you're giving them a job to help their livelihood and their family, and it's just a reciprocal relationship. Um if it's done well, it can be very fruitful from both sides.
Yeah, that's awesome. And then lastly, what is your number one key to success?
My number one key to success, I think, is just being almost stubborn, or have the grit to continue. I feel like every aspect of my real estate journey, maybe I won't say every aspect, but there's been a lot of times in my real estate journey where I could have easily given up. Like the first single family house I bought, the contractor went in before we closed and started ripping it up. And I found out there's a lot of foundation issues that I was going to actually pull out of the contract. And then I found out that he had already went in and started doing it. So I was stuck, or it could have been a lawsuit. Underwriting, I don't know how many deals for 2 years without seeing anything. I think a lot of people would have given up. And um, if you use that stubbornness in positive ways to ignite your flame or fire to do well, I think stubbornness can be a great um, personality trait. I know a lot of people look at it as a negative, but sometimes in business you have to be stubborn. You have to just do things that other people won't, or you have to work significantly more than other people to get an advantage, especially starting out early on when nobody
Yeah.
knows who you are, you don't have a track record, and you can't prove anything.
Right. Yeah. And I think stubbornness, or maybe the more positive spin is like perseverance, right? I think
Exactly.
that, that's a fantastic trait, and has led to a lot of your success. I'm sure it sounds like, and it's that never give up attitude, and you're constantly learning and improving as you go. That's great.
Yeah. I love your perspective on perseverance. That's a much better than stubbornness. But
Well, I asked that question on every episode, and a lot of people have said a lot of like perseverance has been a very common theme among folks that have been successful. What's their key? It's been that perseverance, or hey, that's the stubbornness too, right? You just say, "Damn it, I'm going to do it." Like you're not going to stop me.
yeah, and maybe this is 1A, and I'm sure depending on my mood, it could be, or maybe 1B or 1A. But like I've surrounded myself with some phenomenal people over my
Mhm.
career, and a lot of people talk about real estate being a team sport, and I don't know if I really like that mantra, but it is important to surround yourself with great people, and that can help you, that have personality or skill traits that are a little bit different than yours, that can complement you. And I've been in multiple industries before real estate, and it was very cutthroat. And I felt like the knowledge sharing and the willingness to work together was non existent. And that's
Mhm.
definitely not the case with real estate. And maybe it's because the companies I work for were Fortune 100, 500 companies, but now real estate investors are kind of one-offs or they have a small team. But I love the just the teamwork environment and atmosphere that comes through real estate investing.
Yeah. Yeah. That's fantastic. Yeah. I completely agree with you. And well, great, Sam. Well, thank you so much for coming on the show. Before I let you go, if folks want to learn more about you or what you're doing, how can they get a hold of you?
Yes. Well, Kent, thank you again for having me on the show. And you can reach out to me on my website at batescapitalgroup.com or through most social media channels, or my cell phone's 972-855-7654.
Awesome. And we'll include all that in the show notes so everybody can hit you up on your cell phone. All
Awesome.
right, Sam. Thank you so much for coming on the show again, and have a great rest of the day.
Thank you. You too.